All right, hey everyone, Jeff here at StopThePirates.blogspot.com. Saturday, 2/3, no, 4/3/21. Wow, here in California, the home prices are just skyrocketing, and they say it's because of limited supply. But I think it's more about there's an eviction moratorium going on right now, and they just extended it to I think August, and it's probably going to go on longer than that, probably for the rest of the year, if not into next April. And I think people have figured out that if you can get a loan to buy a house and with minimum amount down, you can buy that house, stay there, or rent it out and not make any payments on it for another year. Take that money that you saved there and invest it in Bitcoin or something else. Bitcoin would be the best, and make money on it. So I think that's probably one of the reasons that the home value are skyrocketing. It's unbelievable. Or people don't want to sell because they're living in their house rent-free or mortgage-free. They don't have to make any mortgage payments. They don't have to make any payments. I think the one payment you would want to make on your house is your insurance payment. Other than that, you can make arrangements with your utilities. You don't have to pay that. Your electric, everything. It's all free right now. It's a free ride. But eventually all free rides got to come to an end, don't they? And that's what I want to talk about here today. But it really doesn't have to do with that, with mortgages and things like that, but it more has to do with how the system works and what you think a bank does if they give you a death pledge, which is a mortgage. French word mortgage means death pledge. But it isn't really what you think it is. Oh, I just had this and I can't find it now. Oh man. Hang on, I'm going to put you on hold here for a second. Hopefully I don't screw this up. Okay, I'm back. Anyway, I found it, what I was looking for. But anyway, there was an interesting case in Riverside, California, where this couple were buying their dream home for like $500,000. Really nice house, 2-story, newish, nice neighborhood. And the deal went through, the escrow closed, and the money went into the guy who was selling the house, his bank. And when it was time for him to move out and hand over the keys, he didn't do it. And so they didn't know what to do. So they called the sheriff and showed him all their paperwork and said, hey, look, he's got the money. We paid for the house. Here's our mortgage paperwork. And the sheriff goes, there's nothing we can do. There's an eviction moratorium going on right now because of COVID-19. And the guy, from my understanding, is still there. And the deal closed like 3 or 4 months ago. And he's just like letting the place go to hell and just an asshole, just working the system. Another thing too is people are doing now, this guy, I heard a lot of scams going on right now during these times, so you have to be careful what's going on out there. This guy rented a car in Las Vegas, a Dodge, what's their hot car, the Screaming Eagle, no, the Dodge, I can't think of the name. Yeah, CRS disease. You don't know what CRS disease is. CRS disease is a disease where you can't remember shit. A Dodge, the fast car, the Hellcat or something. Anyway, it's a really expensive car. And he drove it from Las Vegas. He rented it for a day, drove it to Los Angeles, printed up a fake title, looked exact on bond paper, and everything. It looked totally legit with the stamp and everything. And turned around and sold the car on Craigslist. And so the guy's driving around in his new car. Yeah, I got me a new Hellcat. Woo, 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 woo. Cops pull him over. He's like, what's going on? He goes, this is a stolen car. No, it isn't. I just bought it. Anyway, So this is an affidavit from this guy named Walker Todd, and it kind of explains how mortgages work and what happens with the note. And when you take out a mortgage, that the bank really doesn't loan you anything. But this is a they really don't want you to know about this case out of the state of Michigan, the Circuit Court of the County of Oakland. And the case was Bank One NA plaintiff, and we're suing Dave Harshavardarian and Dave Pratima jointly as severally defendants. And they hired this guy as a consultant and a witness in the case. The defendants did. And this is his affidavit. And you can tell this guy's legit because, well, I'll just read into some of it and give you the highlights of it. It's pretty long, but you'll get the gist of it. And this is the start of his affidavit. Now comes the affiant Walker F. Todd, a citizen of the United States and the state of Ohio over the age of 21 years, and declares as follows, under penalty of perjury. One, that I am familiar with the promissory note and disbursement request and authorization dated November 23rd, 1999, together sometimes referred to in other documents filed by the defendants, in this case as the alleged agreement between defendants and plaintiff, but called the note in this affidavit. If called as a witness, I would testify stated herein. I make this affidavit based on my own personal knowledge of the legal, economic, and historical principles stated herein, except that I have relied entirely on documents provided to me, including the note, regarding certain facts at issue in the case of which I previously had no direct or personal knowledge. I am making this affidavit based on my experience and expertise as an attorney, an economist, a researcher, writer, and a teacher. I am competent to make the following statement. In his professional background is listed here. My qualifications as an expert witness in monetary and banking instruments are as follows. For 20 years, I worked as an attorney and legal officer for the legal departments of the Federal Reserve Banks of New York and Cleveland. And I'm going to give you the kind of the highlights here and not read the whole thing because it'll take forever. But in a fractional reserve banking system like the United States banking system, most of the funds advanced to borrowers, assets of the banks, are created by the banks themselves and are not merely transferred from one set of depositors to another set of borrowers. With the exception of customary stores of value like gold and silver, the monetary base of the economy largely consists of credit instruments. Against this background, I conclude that the note, despite some language about lawful money explained below, clearly contemplates both disbursement of funds and eventual repayment or settlement in money of account. Two different things. This is money of exchange would be welcome, but is not required to repay or settle the note. Lawful money was the form of money of exchange that the federal government or any state could be required by statute to receive in payment of taxes or other debts. In light of these facts, I conclude that plaintiff and defendants exchange reciprocal credits involving money of account and not money of exchange. No lawful money was or probably ever would be dispersed by either side in the covered transaction. Because lawful money would be something that's backed by something, not like gold or silver. And what form of money or credit is the repayment obligation due? Legal tender, one, a related concept, but one that is economically inferior to lawful money because it allows payment in instruments that cannot be redeemed for gold or silver on demand. And this has been the form of money of exchange commonly used in the United States since 1933, since 1964 for silver. And just moving on down here, the referenced official comment notes that the definition of money is not limited to legal tender under the Uniform Commercial Code. The narrow view that money is limited to legal tender is rejected. So credit as money. This is what I've been saying for years is we have an account set up at one of the 12 Federal Reserve banks in the 12 Federal Reserve system, and you have an exemption account where you can draw as much credit as you want. You have an unlimited amount of credit to draw from. The bank being the intermediary because they have a monopoly on negotiable instruments. It's all a scam, basically. The typical form of such extensions of credit was drafts or bills of exchange drawn upon themselves claims on the credit of the drawees instead of disbursements of the bullion, coin, or other forms of money. Drafts and bills came to serve most of the ordinary functions of money. Moving down. This credit money is not alien to the current official monetary system. It's just rarely used as a device for the creation of Federal Reserve credit that, in turn, in the form of either Federal Reserve notes or banks' deposits at Federal Reserve banks, functions as money in the current monetary system. Moving down. Advances of bank credit as the equivalent of money. Moving down. I'll leave a link to this if you guys want to read the whole thing. It's very interesting. It's not an unreasonable argument to state that plaintiff apparently changed the economic substance of the transaction from that contemplated in the credit application form, agreement notes, or other similar instruments that the defendant executed, thereby changing the costs and risks to the defendant. What they're not telling you is they tell you that you're the borrower, but in reality, you're the lender because you're lending the bank your credit, which creates at least the interference of inequality of obligations. Once you get this in your head, the light comes on. You go, oh, okay, I get it now. We're the creditors. They're the debtors. Secured party creditor. This would show that the bank received the customer's signed promise to repay as an asset, thus monetizing the customer's signature and creating on its books a liability in the form of a demand deposit and other demand liability of the bank. Moving down. 12, according to the Federal Reserve Bank of New York, money is anything that has value that banks and people accept as money. Money does not have to be issued by the government. Money doesn't have to be intrinsically valuable, be issued by government, or be in any special form. Moving down. The bookkeeping entries tend to prove that banks accept cash, checks, drafts, and promissory notes, credit agreement, assets as money deposited to create credit, or checkbook money that are bank liabilities, which show that absent any right of set-off, banks owe money to persons who deposit money. Cash, money of exchange, is money. And credit or promissory notes, money of account, become money when banks deposit promissory notes with the intent of treating them like deposits of cash. Anyway, moving down, the newly issued credit or money is similar or equivalent to a promissory note, which may be treated as a deposit of money. And this explains that when banks grant loans, they create new money. So they deposit the note that you sign into an account as a liability, and then issue a check. No, excuse me, I got that wrong. If you read Modern Money Mechanics, page 6 says, what the banks do when they make loans is to accept promissory notes in exchange for credits to the borrower's transaction account. The next sentence on the same page explains that the bank's assets and liabilities increase by the amount of the loans. So the plaintiff, in fact, never lent any of its own pre-existing money, credits, or assets as consideration to purchase the note or credit agreement from the defendants. And there has to be an equal consideration in any kind of a contract, or it's null and void. So the plaintiff, the bank, is trying to use the credit application form or the note to persuade and deceive the defendants into believing that the opposite occurred and that the defendants were the borrower and not the lender. Lawful money language is the repayment clause of the note is confusing at best and in fact may be misleading in the context described above. Anyway, that's basically it. And I'll leave a link to this PDF file down below. You can read this in Modern Money Mechanics. You'll figure out that we are the lenders and the banks are the borrowers. That's why when you deposit your money into a bank, you depose yourself of it, and you loan the bank your money. That's why they're supposed to pay you an interest rate. We are the creditors in this situation. And when that light bulb comes on, it's a transformation thing. Go to stopthepirates.blogspot.com. Get this information out. Get it for yourself. All the technologies and anything you run into legally, and where these banks try to fraudulently come after you and steal your home and everything. Never leave your home. It's absurd. Go to stopthepirates.blogspot.com. Thanks.